Hi friends, welcome to the accountancy class. In this module, we are going to learn about the important liquidity ratios. As we know, ratio analysis refers to a technique of analyzing the financial statements by computing various types of ratios. In simple words, it is a process of determining and interpreting relationship between the items of financial statements to provide a meaningful result of the performance and financial position of a business. Ratio analysis is a study of relationship among various financial factors in a business. Ratio analysis is the process of determining and interpreting numerical relationship based on financial statement. It is the technique of interpretation of financial statement with the help of accounting ratios derived from the balance sheet and profit and loss account. Balance sheet and profit and loss account are the important financial statement of the company. Liquidity ratios, turnover ratios, solvency ratios, and profitability ratios are the important types of ratios. In this module, we are going to learn about the term liquidity ratios. Liquidity ratios are calculated to measure the short term financial soundness of business. The ratio assesses the capacity of the company to repay its short term liability. Banks and other money lenders for short term period are interested in the current assets of the company, that is, short term financial position of the business. This ratio is also an effective source to ascertain whether the working capital has been effectively utilized. Liquidity in the ratio means ability to repay the loans. The ratios calculated to ascertain the short term solvency of the company are known as liquidity ratios. The liquidity ratios are used to test the short term solvency or liquidity position of the business. It enables to know whether short term liabilities can be paid out of short term assets. It indicates whether a firm has adequate working capital to carry out routine business actively. It is a valuable aid to management in checking the efficiency with which working capital is being employed. It is also of importance to shareholders and long term creditors in determining to some extent the prospectus of dividend and interest payment. The important liquidity ratios are current ratio, quick ratio, or acid test ratios. Current ratio is the most widely used of all analytical devices based on the balance sheet. It establishes a relationship between total current assets and current liabilities. The ratio indicates the short term financial soundness of the company. It judges whether current assets are sufficient to meet the current liabilities or not. The company must be able to meet its current obligations out of the current assets. It should not depend upon its long term sources to pay its short term liabilities. The ratio is calculated on the basis of the following formula: current ratio equal to current assets divided by current liabilities. Current assets are the assets which are converted into cash within a year. These assets are cash in hand, cash at bank, debtors or book debts, bills or notes receivable, stock or inventory, prepaid expenses, tax paid in advance, accrued income, and short term investment, etc. Current liabilities are those liabilities which are to be paid within a year. These liabilities are creditors, bills payable, outstanding expenses, short term loans, bank overdraft, cash credit, provision for taxation, proposed dividend, tax deducted at source, and unclaimed dividend. Current assets are those assets which can be realized within a year. In the same way, liabilities which are to be paid within a year are current liabilities. Ordinary investments are non current assets. Short term investments or trade investments or marketable securities are current assets. Loose tools, patents, goodwills, fictitious assets are non current assets. Loan, bank loan, loan on mortgage are non current liabilities. The standard or ideal ratio is 2 is to 1. High ratio indicates under trading and over capitalization. Lower ratio indicates over trading and under capitalization. Thank you.